Welcome to today's explainer. Look, today we are decoding a chart pattern that might look incredibly small, almost insignificant on your screen, yet it possesses the absolute power to reverse an entire market trend. We are, of course, talking about the legendary hammer candle. Okay, let's just address the giant elephant in the room right away. Why do 95% of retail traders actually lose money when trading the hammer? Well, the harsh truth is that the vast majority of traders get trapped in false signals and just drain their capital. Why? Because they treat this deceptively simple candlestick like some magical cheat code rather than actually understanding the market context around it. So here is our roadmap for this explainer to get you to genuine market mastery. We'll cover 1. The anatomy of a hammer. 2. The hidden market psychology. 3. 3 rules for safe entry. 4. Winning trade setups. And 5. Stop loss and targets. Let's get right into it. Part 1. The anatomy of a hammer, where we define the exact pattern. By definition, the hammer is a single candlestick pattern, but here's the key. It is specifically a bullish reversal tool. That means it only holds weight when it appears at the bottom of a chart after the market has been in a short-term downtrend. If you spot one at the very top of a massive rally, yeah, that's not a hammer. Visually, there are strict criteria you need to look for. You want a tiny main body sitting right on top of a massive lower wick. And that lower wick needs to be at least 2 times the length of the body, if not more. The upper wick, it should be very small or entirely non-existent. And hey, quick pro tip here. While a green candle signals slightly stronger buying pressure, a red hammer is perfectly valid too. Honestly, the color is far less important than the actual shape. The core takeaway here is that the length of that bottom wick isn't just random market noise. A massive lower wick directly proves that buyers have aggressively stepped in and pushed the price back up from the lows. So the longer that wick, the stronger the performance of the buyers. Simple as that. Alright, moving to part 2, the hidden market psychology. Think of this as the ultimate tug of war. Picture a violent tug of war playing out in real time. During the preceding downtrend, sellers are entirely in control, right? As the candle opens, they violently push the price down. But suddenly, at those lower levels, new buyers recognize a great bargain and flood into the market, while the old sellers simultaneously start booking their profits and getting out. This sudden, drastic shift in supply and demand causes a massive rejection, driving the price right back up to the open. I absolutely love this analogy. It acts exactly like a beach ball being pushed underwater. The sellers try to force it down, but the moment they lose their grip, the pressure makes it forcefully spring right back to the surface. That long wick is quite literally the visual footprint of sellers losing all their power. Now for part 3, 3 rules for safe entry. This is how we filter out the noise. Before you risk a dime, here are your unbreakable rules. Rule 1, never trade a hammer in isolation. Never. You must ensure it forms on a key support level, a demand zone, or a major moving average. Rule 2, wait for the confirmation candle. The setup just isn't complete until the very next bullish candle breaks the high of your hammer. And rule 3, avoid strong bearish momentum. Look, if the price is violently crashing down with massive heavy red candles, a single tiny hammer is not going to stop it. Don't try to catch a falling knife. Part 4, winning trade setups. Let's look at the rule of 3. So, what specific environments are we actually hunting for? Well, we want to bounce off major support, a safe re-entry point during a healthy uptrend, or a calculated play on seller exhaustion. Let's break each of those down. In the first setup, a downtrend slams right into an established support zone. It's literally like hitting a brick wall. The sellers lose their power, they entirely fail to push the price any lower, and heavy buying steps in to form our hammer candle. Once the next candle breaks the high, you've got yourself a prime long entry. For setup number 2, we're actually in an uptrend, already making higher highs. We just wait for a healthy pullback as some buyers take their profits. The price dips down to a previous high point, turning that old ceiling into a fresh floor of support. When a hammer forms exactly on that new support line, that is your perfect signal to jump back in to the dominant trend. And then there's setup 3. Here we watch for a violent drop, characterized by large red candles to just suddenly lose momentum. The candles get smaller and smaller as new sellers completely dry up. Buyers notice this exhaustion and overwhelm the remaining sellers. When the hammer forms and the price reverses, closing above the hammer, you initiate your long trade. Finally, part 5, stop loss and targets. This is all about protecting your capital. Let's talk defense. Stop losses. While standard placement dictates putting your stop directly below the hammer's bottom wick, we can definitely do better. Placing it slightly below the nearest structural support zone is a much safer way to trade. Why? Because it actively prevents you from falling victim to stop-loss hunting by institutional algorithms. Believe me, they love to sweep those obvious wick lows. 1 to 2. Seriously, burn this ratio into your mind. Every single trade you take using this explainer's methodology must mathematically offer a minimum risk-to-reward ratio of 1 to 2. If you're risking $50, your target absolutely must be at least $100. If the chart doesn't offer you that math, you just skip the trade. No exceptions. Now, for your profit targets, you should look to take your initial profit at the nearest swing high on the chart, but once you hit that target, don't just exit the whole trade completely. Utilize a dynamic trailing stop loss. Move your stop up as the price climbs, so you can confidently ride the rest of the reversal until the market just naturally tags you out. As we wrap up this explainer, if you remember nothing else, remember the golden rule of price action. Context is king. A hammer candle is just meaningless noise without the proper context. A single candle alone cannot reverse a strong macro trend. You absolutely must use demand zones, support levels, and moving averages to back up your thesis. Never trade blindly against the trend without true confirmation. Which brings us to your final challenge. Look, the true test of a focused learner isn't just nodding along to theory, it's having the ruthless discipline to open your charting software right now and backtest these patterns on historical data before risking a single cent. The hammer candle is waiting on your charts right now. The question is, do you have the patience to trade it right? Thanks for joining me for this explainer. This image is for illustrative purposes only. To gain a deeper and more structured understanding, join my community, where you will have access to comprehensive materials and detailed guidance.